Welcome back, traders. Thanks for joining me here today. The next long-term chart pattern on our list is the triple top chart pattern. The triple tops pattern is a reversal pattern formed after an extended bullish price movement, resulting in 3 swing highs. A triple tops pattern suggests bearish anticipation. Remember that a double top is not technically confirmed not until there's a bearish price breakout and a retest of confirmation. Therefore, the triple top can result from the failure of the confirmation of the double top chart pattern in the market. I will show you the 2 ways to apply the triple tops chart pattern in the market. First, I will show you how to apply it in a downtrend as a continuation sell trading strategy in this video. In the next video, I will show you how to apply it for the reversal of a bullish trend. Here's a powerful downtrend on the chart of the Euro USD. As we can see, the market was making a lower low and lower high. This is the type of market trend to apply the triple top as a sell continuation trading strategy. Let's apply our Fibonacci tool to see the point of the appearance of the triple top in this downtrend. We need to apply the Fibonacci tool from the last lower high swing here, and draw it all the way down to the last lower swing that led to the bullish swing that resulted in this triple top in this downtrend. As we can see, the application of the Fibonacci tool revealed to us that the triple top formed at the midpoint of the 61.8% Fibo level. This thus adds to our confluence factors supporting this triple top as a potential chart pattern to lead to the continuation of this downtrend. Do not worry for now if you do not understand how to apply the Fibonacci tool and how to build confluence factors in trading. I will educate you on how to apply the Fibonacci tool plus confluence factors trading strategy in the later episodes of this trading course. Remember I told you it's necessary to wait for a retest of a broken neckline of the double tops in a downtrend because the pattern technically supports the existing bearish trend. The same rule is applicable to the triple tops in a downtrend. Let us study the psychological analysis behind the formation of the triple tops. As we can see, price switched from the bearish hands to the bullish hands in this downtrend at the swing lower low at $1.03500. This is normal because in a downtrend, there will be a time whereby sellers have to give room for the buyers to exercise some transactions in the market. For every seller, there must be an active buyer. Price resulted in a series of short-term bullish waves in this downtrend. Although this bullish move is a counter trend, after buyers made their move to the 61.8 Fibonacci retracement tool, there was a balance between the buyers and the sellers. This medium of balance resulted in the triple tops you see here. The triple tops signify the point at which sellers balanced the action of the bulls by resisting price down. Likewise, the swing lows at the neckline are the points at which the buyers balanced the action of the seller. These triple tops are points of opportunity for institutional traders to add to their selling orders. Also, these are the points at which bold retail smart traders get into the bearish trend. Remember, you should sell high and buy low. Suddenly, a time will come whereby the market will plunge below the neckline due to large selling order that is greater than the buyer's order at the neckline. This is a simple explanation of what brings about the formation of the triple tops in a downtrend. Now you can see why it's easier to make money in the continuation of a trend. At the time of producing this video, I'm still holding and trailing my sell position on the Euro USD based on the bigger falling channel in this downtrend. To make an entry on the triple top chart pattern, patiently wait for a bearish close of price below the neckline structure here. Once there's a bearish close of price, the next step is to calculate your risk and money management tolerance before selling based on the high of the last third top swing here. The third swing top is the best zone to place your stop loss. Although there is a price action retest of the broken neckline structure here. Technically, this is not in favor of my personal risk setup level based on my trading rules. When a pattern is too obvious, institutional traders are found to usually cut off the masses from benefiting from such movement. The institutional traders have to make money, but they can't make money following the crowd. Also, let me share with you additional information in this downtrend. Let's zoom out. From the last high here to the lower high here, the triple top here, we have a falling channel. This is another confluence factor for this triple top pattern in this downtrend. Therefore, I am placing my stop loss above the third top. Also, above the downtrend channel upper trend line. Also, above the 61.8% Fibonacci price level. Technically, I have my stop loss placed where the market will prove me wrong and not set based on my pain level or personal thoughts of how I want the market to move. Also, there's enough room for my sell trade to run for at least a potential profit of 2.5 plus risk to reward ratios based on the falling channel in this downtrend. Take profit targets can be set based on 3 options. Option 1. Apply the measurement objective target. To do this, take the measurement from the tops to the neckline, and then replicate the measurement from the neckline breakout point all the way down in order to forecast the potential bearish price movement objective. Option 2. Target the next potential strong support level in the market. Option 3. Trail your profit down until the market hits your trailing stop.